What are we doing today? Just a little bit of quiet. There's not nearly as much conversation or chatter going on. I'm gonna say four letters, and you can tell me if this is appropriate. AYCD? No, no, no. It's just Friday. I see some nods. I see some nods going. No, that was actually Dr. Caden. She taught Monday when it was her Friday class. She said, "Yeah, Friday mornings are kind of difficult because my students they have AYCD and they're just a little bit less responsive on Friday mornings." You'd think that if I was a compassionate individual, I wouldn't give you quizzes on Friday mornings because that's just the worst thing. Well, my expectations of you are very high. I'm assuming that even if you thoroughly enjoy yourself and kind of relax a little bit on Thursday night, you will come in on Friday with that incredible level of knowledge and be able to pass those quizzes shining colors, or not. That would be unfortunate if that was the case, but my expectations are high. So today we're going to talk about chapters 12, 13, and 14 of Bad Blood. Chapter 12 is kind of a downer to start with because that's Ian Gibbons. And poor Ian Gibbons, he just did not get his due. I think the biggest thing that really just drove me up a wall about Ian Gibbons is he worked closely with Channing Robertson in the 1980s. Like they were just buds. And it's like really, really good pals. And Channing Robinson goes on bigger and better things at Stanford. He even Gibbons stays in the private sector, and he goes to work for Theranos. On the advice of Channing Robinson, says the next big thing. Then Ian's like, "Hey, Channing, this place you think is amazing? Yeah, it sucks, and you probably should know about this. You and the board of directors." And Channing's just kind of like, "You know what? I know we're friends from a long time back, but I Elizabeth's like the daughter I never had, so I'm going to throw you under the bus here." But yeah, so yeah, that's just. That was really unfortunate. Sonny hires him back and then basically says, "Yeah, we need your technical expertise because you basically wrote all the patents that our company is based on, but we're going to put you in the general population of all the workers. You're no longer special." And so, really, really sad story. And kind of Ian Gibbons was supposed to be deposed by the news team. Never got a chance as he committed suicide. And really, really ugly trial there. I think the worst thing is the very end is just they're talking about how it was treated with internally. You think this is a moment for Elizabeth Holmes to show compassion, and basically it's like, "Oh, he died. Well, that sucks. Business as usual, And so everybody's like, I did catch. There is one thing that was very interesting. So did everybody catch the name of the relationship that Ian Gibbons used to describe Sonny between Elizabeth and Sonny? Called a folie à deux. Folie à deux, which up until like a year ago, nobody would have known what that represented. And that god awful Joker movie was released, okay, and everybody's like, "Oh, folie à deux." Well, they actually described or defined what a folie à deux is the same delusion shared by two minds, and so I think that's probably a compelling depiction of Joker and Harley Quinn as well as Sonny and Elizabeth. There we are. Chapter 13 was Chiat Day. Chiat Day was basically trying to prepare for the big Walgreens launch, which Elizabeth promised was going to start in September of 2013. And so they're getting the website going up, and the website is supposed to go live in February, but Elizabeth kept pushing it back. And then all the language that they put on the website, like the night before the launch, they basically said, "Hey, your reviewers looked at this, and we can't use this language because it's all a bunch of filthy lies. And so we need to roll back some of the language." And so they end up spending like in a 3-hour meeting trying to change the language that's going to be on the website. And so kind of further evidence that Theranos kind of knew that they were totally fabricating information, but were just okay with it as long as they get away with it. When the legal team said, "Yeah, we can't get away with it," it's like, okay, well, we better change it back to something that's a little bit less completely and totally wrong. So. And then, interesting, the third chapter that we read was about Alan Bean. Now, this is kind of an interesting guy because he's going to come up a lot in the book. And I try to avoid saying what's going to happen in the future, but the only reason I mention this is when I watched this TV series, The Dropout, I was waiting for Alan Bean to show up, and there was never a character named Alan Bean, but there was a character who kind of looked like Alan, or like took the role of Alan Bean. He was a lot more adversarial a character than he is in the book. He's not named Mark Rossler, and he kind of in the TV show, The Dropout, he kind of comes off as vindictive, like or Elizabeth did me wrong, so I'm going to tear the company apart. And basically, if you remember from the early part of the book, John Carrier says that some of the people that were in the book wanted to actually have their names hidden. So Alan Bean was not actually the guy's real name. Neither was Mark Rossler. fact, it was only until the trial came out and Elizabeth was convicted. So his name is Adam Rosendorf, which that's not going to be on the quiz. Maybe it'll be on a quiz. Who knows? But yeah, Adam Rosendorf is Alan Beam. That's the same person as Mark Russler in the TV series. And I think, to my knowledge, that's really the only person that's in the book that's a main character that had their name changed. Like everybody else was kind of on their original names. Like when you start looking at some of the other characters a little bit later on, they're all the same names, all the dignitaries, all the executives, everybody kind of saying the same name. But Alan Beam was kind of an interesting one, and as we're going to find out, is that this guy is just super paranoid, and so that was kind of the reason, and for good reason, because we're starting to see at the very end of the chapter 13 was talking about the lady who was working in one of the or I don't remember, one of the areas. It was basically trying to develop some of the testing, and she said she went off to India. She took a trip to India, and she came back and says, as long as we're not using this in the real world, then everything's fine. And then started hearing about the Walgreens launch, and so she said, like, I can no longer deal with it. And I apologize, I can't remember her name or what division she was working in. But she ended up leaving, and she ended up copying out of a piece or a letter to say that or the email that she sent to Sunny Elizabeth, voicing her complaints, and got a paper copy of it because basically everything was shut down. And as we're going to see, that's kind of where everybody starts gets bedraggled pretty thoroughly by Theranos. So when they try to take proprietary information, and they're going to start using this term called trade secrets a whole lot. And the term trade secrets gets tossed about and bandied about a whole lot. And the idea being is that any information that Theranos has is proprietary, you can't share it. That includes information that basically disparages Theranos and show that they're completely, totally fraudulently gaming the system. So keep an eye out for that. That's something that's going to be relevant for Alan Beam in the very near future as well. All right, with that, we come up with some CPA prep questions. All right, so some interesting questions here today. Starting off with a strong one. Analytical procedures performed in the overall review stage of an audit. Now, when you read this, you need to make sure you're thinking about what it is, what points in the audit are we actually referring to. And it says overall review stage, which probably talks about which type of analytical procedure: preliminary analytical procedure, substantive analytical procedure, or final analytical procedure. What do you guys think? Preliminary, substantive, final? No, other side. Preliminary, yeah, there we go. Good guess. So the overall review stage is basically saying, look, we're trying to review the audit, or trying to review the process, and trying to make sure if we understand if anything works is the case. And so we're kind of reviewing and test to make sure. Actually, hold on, I'll make sure. Now that I think about it, I think you may be right. I think it may be final analytical procedures. Now that I think about it, I was so gung-ho on preliminary, I didn't even consider the possibility of final analytical procedures. All right, so let's go ahead and back up on this one. So so analytical procedure overall review stage of an audit suggests that several accounts have unexpected relationships. Now, if we're assuming this is final analytical procedures, which is funny because I didn't assume that when I walked into this, what is that looking for? Well, remember, the whole goal of final analytical procedures is to make sure everything is consistent and makes sense. Okay, if something doesn't make sense, then we might want to look at it a little bit more in detail, a little bit further. And if that's the case, if we're talking about trying to make sure that we're making sure everything's the case, what is that going to suggest? Now, there's a few possibilities here, and we can kind of go through the process of elimination on these. So regularities exist among the relevant account balances. Now, assuming this were final analytical procedures at this point in the audit, we've already tested to make sure there's no irregularities. So that would would not necessarily be the assumption that we go with. We probably would say there's something we can't explain, but we're not assuming there's irregularities. So A is probably not our answer. It seems like it's a possibility, but it's not a likelihood. B, control activities are not operating effectively. This one's pretty easy one. We know control activities are not operating effectively because they occurred earlier, before. We've already done the testing on there. C says additional test of detail required. So this one's kind of an interesting one because we say we can't explain why these analytical procedures have these relationships, why these numbers are the way they are. What is the way that we would approach this particular test? The answer is we would probably perform additional test of details to try to explain the relationship. So C is the most likely answer, but let's look at D. Communication of those charged with governance should be revised. Now, do we need to actually communicate anything to the audit committee or to the board of directors if our analytical procedures end up looking a little bit wonky? Is that a required communication? No, it's not. So C is our answer. All right. Number 2, which of the following circumstances would most likely cause an auditor to consider whether material misstatements exist in the financial statements? Now, this one's a great question in the fact that there are 2 possibilities and you have to select it. But when I say great question, I'm not saying that I would ask you a question like this if I were trying to ask you just a very objective question. It's a great question in preparing you for the type of question that you're going to see on the CPA exam. So 2 of these answers we can just toss out really, really quickly. Okay, management places little emphasis on earnings projections. Or if you're an auditor and you see that they're not placing a lot of any emphasis on earnings, are you going to have a lot of concern about misstatements in the financials? No, if they're not placing emphasis on earnings, then probably what's happening is that they're happy with the way things are going and things are going to be great. So there's a little chance of intentional misstatement there. Board of directors makes all major financing decisions. So question, should the board of directors make all major financing decisions? Yeah, absolutely. So A and B sound like business as usual, things that are good practices. Now we have C, significant deficiencies in internal control previously communicated to management are not corrected. Now, here's an interesting question. Could this raise your suspicions about material misstatements existing? Yes, because remember, significant deficiencies by definition are things that become a kind of material effects if left unchecked. So C is very definitely a possibility. But let's go ahead and go through D, because we're looking for the correct answer, not the correct answer, but the most likely answer, the most likely scenario. Transactions selected for testing are not supported by proper documentation. So we perform a series of tests. Okay, we're going to see, all right, we're looking at confirmations for accounts receivable balance. We send a confirmation out, we don't get a response, and then we go and we check and we say, wow, this is interesting. I don't see any information that relates to this this entity that they sold goods to be a valid entity. There's nothing on the internet. There's no support or any documentation of this vendor existing. Which one is going to be more a likely scenario? The scenario where a significant deficiency has gone unchecked for a couple of years, or that you have just no underlying support for any of the transactions that you test? Which one's going to be the most likely, most suspicious to you as an auditor?
The second one.
The second one, D. Okay. Is that not saying I'm not saying C is not a possibility. I'm saying the most likely scenario is going to be D, which is why this is a good question for testing your knowledge. Not a good question for saying, okay, I'm looking for objectively the correct answer. AI would struggle with this particular one because they'd look at C and say, well, C is correct. And then Sydney would get an argument with it, and that would just never end, you know. Diagram below depicts an auditor estimated maximum deviation rate compared to the tolerable rate, and also depicts the true population deviation rate compared to the tolerable rate. As a result of testing controls, the auditor assesses control risk too low and thereby decreases sensitive testing. This is illustrated by the situation of what? So we have to answer 2 questions, okay? What does assessing control risk mean too low for the sample? And what does it mean for the population? So if you assess control risk low, basically based on sample testing, if you're assessing control risk low, you're saying the sample shows that the controls are operating effectively. Okay. Can we all agree on that? That the sample is saying the controls are operating effectively. That would be our maximum deviation rate is less than our tolerable rate. So we can say this top row right here. But then we need to answer the question about the population. It says control risk is too low, which means that in the population, the control is not as effective as we'd like to say as is in the sample level. In that situation, we'd say the deviation rate exceeds the tolerable rate. So we need to identify what's going on in the sample and what's going on in the population based on the characteristics in this question, basically saying 3. That's the area that we're operating with. Saying everything's fine according to the sample, but the sample is not representative of the population. Therefore, we have a misjudgment because we're saying that the sampling risk is too low. Yeah. Results of the test samples results in control risk is too low, not sampling risk is too low. For which of the following tests would an auditor most likely use attribute sampling? So before you even answer this question, this is a throwback to 417. I've mentioned in this course before. Remember, we taught 2 general categories of sampling. We have attribute sampling and variable sampling. Variable sampling is generally used to extrapolate misstatements in account balances. What is attribute sampling generally used for? What category of tests? So substantive test or test of controls, one of the 2. There we go, test of controls, yeah. Because remember, attribute sampling is just basically saying, does a characteristic exist? In the test of controls, you're trying to say, is the control effective? So it's a yes/no question. So in that situation, we're looking for specifically a test of controls, okay? So which of the following audit tests would auditor most likely use attribute sampling? Making an independent estimate of LIFO inventory. Is that attribute sampling? What do you guys think there? Well, we're trying to make an estimate. So that would not be that would not be attribute, that would be an amount, okay? Examining invoices in support of the valuation of fixed asset additions. What do you guys think about that one? That also seems like we're trying to make an estimate there. We're trying to do a calculation. Selecting accounts receivable for confirmation of account balances. I specifically said account balances was variable sampling. So we have one left. Inspecting employee time cards for proper approval of supervisors. Does that sound like a test of control to you all? Sure does. Is the control effective? Yes or no? So D is our answer. All right, here's a fun one. So auditor partners doing some training about sampling. And prepared this table to show population characteristics on specifications of two populations. All right, so before we actually go into this question, let's go ahead and approach this a few different ways, okay? Or I want to approach this and make sure our expectation. So this is saying characteristics of population relative to population 2, and the audit specifications of population 2. What I'd like to do is for each of these columns, I'd like to specify what is going to be the relationship we would expect. Would it be a direct relationship? So as one goes up, the other goes up, or an indirect relationship, or one goes up, the other goes down, okay? Or in one scenario, there's not really a relationship whatsoever, okay? So population size, what would we expect the relationship between the populations to be with respect to sample selection? So if the size goes up, would the sample go up? I mean, answer is technically yes, but what do we say about sampling way back in the day is that as long as it's a large enough population, size does not matter, okay? All right, so size is irrelevant. We're just gonna put a big X for the size and kind of ignore that. Variability, okay? So variability is basically saying variance in the sample. If variance in the sample gets larger, then do we need a larger sample or a smaller sample? So higher variance means that we're going to have larger samples, so there's going to be a direct relationship here, direct relationships. All right. Specify tolerable misstatement. So tolerable misstatement. What was that, by the way?
You just broke the chair.
It happens. I don't think it's the first time the chair's been broken. Okay.
Yeah.
You need to change chairs? We can take it.
Just one in back.
I like your attitude. You're really, really enthused about sampling discussion.
Yes.
All right. Specify tolerable misstatements. Tolerable misstatements. Does that have a direct relationship or an indirect relationship with sample size? Yeah, indirect or inverse relationship. I said indirect, but inverse. Inverse relationship. As tolerable misstatement gets larger, our sample gets smaller, and vice versa. Specified risk of incorrect acceptance. Okay, specified risk of incorrect acceptance. So this is our sampling risk. So let's go ahead and talk about this. What is if I take 1 minus sampling risk, what do I come up with? Does anybody remember that term? It's called confidence level. Okay, and so as confidence level gets larger, my sample has to get larger too, because I got to be more confident. So if this is basically the inverse of confidence level, that means there's an inverse relationship there. As sampling risk goes up, then our sample size goes down, and vice versa. Okay. All right, so keeping those in mind, let's go ahead and look through these. So for each of the following cases, we're going to be talking about. So each of the 5 cases above. So yeah, so we're going to talk about each of these 5 cases. So first one, equal, lower. So again, we can ignore size, we can ignore variability as specified so the images are equal, but the specified risk of incorrect acceptance, our sampling risk goes down. What does that mean about the sample for population 2? If the sampling risk is lower, that means the sample size needs to be smaller or larger. So we said that it's an inverse relationship here. So if this is getting smaller, our sample size must get larger. So A is the answer. Okay. Case number 2. Equal, larger, equal. Okay, so we can ignore size regardless, and we can ignore specified risk of incorrect acceptance. Variability, we said variability has a direct relationship. As it's more variable, then we have to increase the sample size, okay? But tolerable misstatement has an inverse relationship. So as tolerable misstatement goes up, sample size goes down. So this one's making the sample go up, this one's making the sample go down. What does that mean? We don't know. We don't know what what's indeterminate. We don't know which one's got the greater effect, okay? So you could make an argument there's no change if there's exactly the same effect between these two, but we don't know has the greater effect on sample size because one is going to affect sample size and make it go up. One's going to make it go down. The end result is we're not sure. So this would be D, where it's indeterminate given the sample size of the population. All right. Case 3, we ignore size, we ignore variability. Specified tolerable statement is smaller, so this is an inverse relationship. So tolerable statement is going down, so basically our population is going to have to go up. Specified risk of incorrectness is higher, so this is going up, and this has got an inverse relationship as well, so it's going to go down. This one's going up, this one's going down. What does that mean? We don't know. Okay, it's indeterminate relative to the sample size of the population. All right. Smaller equal higher. Again, ignore size. Variability. Smaller is going to be a direct relation. Variability is a direct relationship. As it gets smaller, our sample size gets smaller. So this is going down. And then higher, as this gets larger, it's got an inverse relationship. So this is also going down. So both times we're going down a direction, which means that our sample size is going to be smaller, C. Okay. Then finally, case 5, ignore size. Ignore variability in this statement. All we are going to focus on is specified risk of incorrect acceptance. It's lower. It's got an inverse relationship here. This is going, so the sampling risk is going down, meaning the sample is going up. So it means that our sample size needs to be larger, needs to be A. So just for context, just so everybody knows, okay? Question number 1 was A. Questions number 2 and 3, case number 1 was A. Case number 2 or 3 were D. Case number 4 was C. Case number 5 was A. All right. If you understood those concepts pretty cleanly, then you should feel pretty good about where you stand with sampling. I'm not going to say it's going to test you everything on sampling, but this was a challenging question. That's why we did 5 different variations of it. So, all right. An organization decides to use regression, which is a forecasting model. What type of data analytic process would it be implementing? So this is probably a question that will come up. They've been a lot of focus on data analytics, especially as it relates to audit. So let's just go ahead and make sure we know what each of these analytics types do. So descriptive analysis or descriptive analytics basically asks a question of what happened. A diagnostic analytics says, why did it happen? A predictive analytic is saying what will happen. And prescriptive analytics is a little bit wonky. It says, based on what we think will happen, what should we do? All right. So make sure you have those clean in mind. It's probably only going to be 1 or 2 questions, but it's very easy. And it's probably good to know what those types of analytics that they're talking about. So we're talking about a regression. What are we trying to determine? So regression is basically saying a line of best fit. Look at historical data to interpret what we think will happen in the future, what we will predict will happen. So that sounds like a predictive analytic to me. And so that's A, that's our answer. All right. Which of the following concerns regarding data mining is or are correct? So what is data mining? Remember, data mining is taking a large database and trying to identify information that or data that is relevant that can be converted into information, I should say. So one says data mining is the analysis of data and data warehouse performed in an attempt to discover hidden patterns and trend of business. Okay, that's a much fancier way of what I said, and that sure sounds correct. So one is correct. Data mining assists managers in making business decisions and strategic planning. That probably sounds like a rational approach for data mining, something we should do. Although it take a little longer without a computer, a manager would be able to perform data mining analysis manually. All right, there we have it. Now, when I read this question, I think about that movie Lucy with Scarlett Johansson in it, where she basically becomes a giant supercomputer. In that situation, 3 would probably be okay. Okay. Otherwise, I'm going to assume that most human beings cannot perform data mining manually. It's not one of those things that you can say, can you print out all those records for me? And I'm just going to go through and read through and see if I can find patterns. You got like 1 billion pages of paper, and you're just kind of like saying, okay, I'm going to spend the weekend looking through this stuff. Yeah, it doesn't work. So 3 is out, 1 and 2 only. A. All right, moving on. Fast-based simulation stuff. Okay, so we got some financial information and we've got some expectations, and we're going to try to make sure we determine what's going on here with respect to this. Now, I do want to make a note here. There's something that comes up that's really, really nuanced. Remember, we talked about analytical procedures back in 417. We talked about the concept of tolerable difference. The idea that it has to be within a certain range. Now, does everybody remember what the rule of thumb back was with 417 when we talked about analytical procedures and tolerable difference?
5% of your expectation.
5%, it is 5% in the expectation in this one. When we talked about it back in 417, it was 5% of the reported amount. That's the reason I'm bringing it up. In this one, Matt correctly identified that they actually specified it's 5% of expectation. It's a little bit of a change from what we saw before. It's important to make sure that you read and you identify those particular characteristics. And this is different from what we expect. A rule of thumb is just a general guideline. It doesn't mean it's applicable in every scenario. So you should ask about, if I'm looking for this particular piece of information, what is my metric? And in this one, 5% of expected amount. So we're gonna do some calculations and we're gonna determine if it's within 5%. All right, so hopefully this was an opportunity for you to let your accounting wings fly, because I kind of starved you all of doing calculations in this course, all right? And I know that there's probably some hard feelings, and I understand that. This is my attempt to get back in your good graces before spring break, okay? So yeah, we're gonna do a final task-based simulation before spring break. And we're gonna actually do some calculations here, because I do enjoy math too. I just don't get to do it as much because it's a qualitative discipline. So average salaries increased increased 2% effective January 1st to year two. Average headcount was 200 in year one and 300 in year two. So let's go ahead and take a look. So we've got some information here. We are trying to determine salary expense if this number is consistent or consistent with an expectation. So we're developing our expectation based on this $8 million in year one. So what would be my first step in developing this expectation? Dividing 8 million by what? Divided by 200, yes. That gives me a salary of $40,000 on average per individual organization. Now I can multiply this times 300. And I come up with 12 million. Now, is there anything else I need to consider here before I move on?
2% growth.
Yeah, 2% growth. So I'm going to multiply this times 1.02. This is my expectation. Now, is this close enough to 12,500,000? Answer is we don't know. How close do we have to be? We need to calculate that tolerable difference. 12,500,000 times 0.05. We need to be within 625,000. So 12,240,000 within. Nope, sorry, did I get that wrong? That number
You use the actual amount instead of the expectation for the 5%.
No, I use the expectation. Or sorry, the reported amount. Oops, no, I'm sorry, you're bad. You're right. I'm bad. Yeah. You're bad. But you're right. 240,000. My bad is what I was trying to say, but unfortunately, it came out wrong. I'm gonna have to apologize to Matt profusely for that. Matt, you're right, and you're good. Right. So everybody else is bad. All right, 612,000. So 612,000 is the expectation. So 612,000 is that 12,240,000, is that within 612,000, 12.5 million? Obviously, just looking at it, we can say yes. Okay, these numbers are about 300,000 apart, so we're well within that 612,000. So let's go ahead, plug in our expectation, 12,240,000. Oops, add another zero. What's our decision here? It's in threshold, no further testing or needed. Very good. All right. So now, moving on. Building one and building two. So there's some interesting information going on with building one and building two. Rent expense increased halfway through the year, and then they brought in a new building at the beginning of the year, 45,000 a month on a month-to-month basis. Now this is basically trying to calculate their rent expectation. So let's go ahead and let's go and look at some information that they've got for rent expense here. So again, this $1.2 million is based on one building rent. And so this 1.2 million is a pretty good baseline for us to start our calculation. So 1.2 million, oops, I guess I should probably, oops, come on, there we go. 1,200,000. And then I'm going to take half of that because I want to know what was the increase for the latter half of the year. And they said they increased by 5%, so times 1.05, so 630,000 plus the original 600,000 they would pay at the beginning of the year. That's the expected rent on building one. Unfortunately, we're not done with their expectation because we also have $45,000 per month for the new building. So 45,000 times 12, 540,000. So we're 1,770,000. That's our expectation. So holding on to that, times that 0.05, we have to be within 88,500. Is 1,770,000 within what 88,000 of 1,920,000? No, we're over 100,000 difference here. So we're definitely not within range. So our answer in this one would be 1,770,000. And the recorded amount is above the acceptable amount. Further testing needed. Okay. Utilities based on square foot of village facility, the rate did not change from year one to year two. Okay. So it's important to note that we did add 11,000 square feet in year two. So even though the rate did not change, our amount, our utilities expense is going to expect to change because we did have an additional square footage added. So let's go ahead and do our expectation per square foot. So we know 120,000 divided by 25,000 square foot, $4.80. That rate did not change. So we're gonna add square feet for the new building, gonna be 36,000 because 25,000 plus 11,000. So multiply that times 36,000. Our expectation is $1,72,800. Utilities expense is 155,000. So multiply that times 0.05. I can already tell you, oops. Probably not gonna be close enough, okay? So 172,800 needs to be within 8,600 of this amount. It's not. We're off by over 10,000. So in this one, we're gonna say 172,800. And the recorded amount is below the acceptable amount. We're gonna have to do further testing. How are we doing so far? Everybody feeling pretty good? All right, fantastic. All right. So let's keep going. Calculation for miscellaneous based on 0.2%, 5% of gross revenue. This one's an easy one. So oops. We don't even need to think about year one. You just say 63 million. Multiply it 0.0025. Our expectation is 157,500. And miscellaneous is 151,000, but we still need to know our tolerable difference. So multiply that times 0.05. 7,875. Are we within that range? 1,157,500, 100,000. If I have to do the calculation, the answer is yes, we are within that range. This is actually about 6,500 off. They're within 78.75. So 157,500 within threshold. Makes you feel good right there when you do a very simple calculation and it's enough evidence to accept the amount. You know, like that's like a 5-minute audit procedure. You're just kind of like, I just got to document this and then I can go hang out on the beach, you know, or hang out in the audit room and do something else. One of the two. All right. Repairs and maintenance is based on the average gross value of assets at cost. All right. Now, average gross value, it's important to note that we've got 3 different amounts here. Calculations for average gross value is going to be what the average gross value is over the entire year. So if we're saying the beginning of the year and the ending of the year, it's just the average of those two, which for year one or for year two, the average of that year is just going to be 3.3 million plus 2.7 million divided by 2, which is $3 million. And then we do the same thing over here, 3.7 million plus 3.3 million would be $3.5 million. Those are pretty straightforward calculations, but using those calculations, all right. So repairs and maintenance based on average rent cost. Let's just go ahead and do some percentage analysis. So repairs and maintenance is $300,000. Our expectation for repairs and maintenance, the percentage of repairs and maintenance of the average square foot is going to be divided by $3 million. Because remember, for year one, I guess year one going into year two, I apologize, I kind of misnomer that. For year one to go into year two, it's going to be an average of $3 million for the year of average gross assets. So maintenance would be 10% of gross assets. Now we can take that and multiply that times the 3.5 million, which is the average here, to come up with an expectation. So multiply times 3,500,000. Our expectation is 350,000. Our actual amount is 375,000. Are we within 5%? And sadly, the answer is going to be no. Okay, $25,000 difference. We need to be within 17,500. So 350,000. This one was a little bit more challenging. Everybody got 350,000. See how that came up? Okay. And then the amount that was recorded was above the acceptable amount, so further testing is necessary. All right. Average percentage of SDA's debt is 7%. Okay. So it says the balance of interest-bearing debt outstanding is 4.83 million at the beginning of the year, at 1.262 at the end of the year. They issued additional debt on July 1st, year two. Isn't that nice? We don't even have to worry about the weighted average because it's right in the middle of the year when this transaction takes place. Isn't Becker helpful? Isn't that really, really nice so they don't have to worry about the weighted average? We just say, okay, what's the average of 10 million? Oops, not up here, right here. 10,262,000 plus 4830000 divided by 2, average debt outstanding was going to be 7,546,000. Multiply that times the 7%. This is our expectation. Our interest expense is 523,000. I feel pretty good about this one. Multiply times 0.05. Oops. 0.05. That's what I said. Yeah. 26,441. So we need to be within 26,000. We're within about 5,000 here, so we're pretty good. So 528,220 within threshold. Before we break, though, I do want to talk about this. This is an interesting question, okay? So we have beginning of balance of year 1, ending balance of year 2, all right? And it gave us a piece of information saying the outstanding additional debt was on July 1st, year 2, which made things really easy because the additional debt was added exactly halfway through the year. How would you approach this question if they said this debt was added at the beginning of October?
You take the amount of debt added, so take your 10 million minus your 4.8, and then you take that and you're gonna multiply that by, don't remember, by 3 out of 12.
Yeah, so there's a few different ways you can do it, but basically we want to make sure we have a proportional amount. What if in this scenario, what if they gave you this information January 1st, year 2, and December year 2, and they did not give you this other piece of information down here? What should your assumption be? That it was added at certain intervals during the year, but there's no timing information for present, so you just take the average of these two numbers. So keep in mind that if this was a proportional balance, like if you wanted to know what the year 2 was, or sorry, what the year 2 balance was, the balance for the year was it was added at some points during the year, a little bit later or a little bit earlier. Keep in mind that you would have to do a proportional calculation for that. Not particularly difficult to do, but this one was very easy in the fact that because it was added at halfway during the year, half of the year was at this value, half of the year was at this value. That's really all there was to it. But yeah, I just wanted to kind of make sure we had clarification on that. I think it would be very interesting to kind of do a calculation on that of that sort, make sure that everybody's on board with that. So just as a hint for what might come up on the next quiz. I don't know. I've already written the quiz. I don't think that's it. But all right, we're done here for today. I'll see you all on Monday.